This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making from two Canadians. This week, we're hosted by me, Cameron Passmore, Portfolio Manager, and Mark McGrath, Associate Portfolio Manager at PWL Capital.
Welcome to episode 331. We're back to two Canadians, eh, Cameron?
Back to two Canadians, and that is the first time the intro has not been from Ben.
Has it really? The very first time, wow.
There's one other episode where I did it alone. This is the interview. I interviewed Dave Butler from Dimensional in Australia. And he did the intro. That's the first intro that he has not done. So
wow.
Might be a little bit of trauma for him when he gets back.
I was going to say, I wonder how he feels about that. Where is he?
I think he's off to Boston.
Nice.
Alma mater, which is kind of cool. A basketball event he's off to, which is really nice.
Oh, that's right. I think he said a friend of his is being inducted into the Hall of Fame there.
Yeah, so he's taking the kids and his wife to the game on this weekend. Super fun. Great town.
Never been.
Never been to Boston. Oh, Boston's wonderful.
No,
wonderful
I've
city.
heard. Yeah, one day.
Yeah, it's super close. Closer for us than it is for you, but one day. Anyways, on today's episode, we thought we'd talk about my presentation I delivered to an event in Norway last week, which was an incredible trip, incredible country. I don't know if you've been to Norway, but maybe we can talk about that in the Aftershow. But I thought I'd go through the presentation that I delivered there, and then it's kind of a bit of a my story kind of thing, and you've got an incredible story as well. So we're going to interject some questions back and forth during that portion. So that should be interesting, I hope. We'll see.
Yep.
And that'll be it for today. We'll do the after show and talk about a bunch of different things. How does that sound?
Sounds good. Yeah, I'm excited about this. I'm excited to hear your story, and I'm excited to have the opportunity to ask you some questions about it. I think it'll be very interesting for our listeners.
Well, likewise, I think your story is equally, if not more interesting. Yeah, it's been an incredible year this year. You know, we've been reached out to by so many Canadians looking for financial advice. It's very gratifying to be able to help more and more people. So a thank you to those that have reached out. Many listeners have reached out looking for some help. And I was telling someone this morning, I did a presentation to a group in the U.S. this morning talking about the number of advisors and individuals that reach out to me on LinkedIn just to get some sort of feedback on career decisions, where they're working, what's it like to be in the financial planning industry, and how best to do that. So that's super fun. So as always, if you want to reach out anytime, I'm easy to find, and as are you. Mark, I know you talk to a lot of people as well in the industry. So we love giving back. We're very grateful for the chance to help people. So reach out.
Yeah, I actually had a meeting with an advisory team this morning that reached out on LinkedIn. So I think we've talked a couple times on the podcast how PWL is looking to meet more like-minded advisors that are aligned with the PWL philosophy and values. So I've been getting a lot of traction from people just reaching out to have conversations and kind of learn more about us. And I think what you and Ben have done here with the podcast is connected a lot of advisors that were maybe operating kind of in their own silos, but really were thinking and doing kind of similar things to what PWL is doing. So you've brought that community together really nicely, and it's great to connect. So anybody out there that's listening, I'm very easy to get a hold of on LinkedIn. Just reach out.
Well, this revolution's in full swing, right? The awareness around this message, this philosophy, fiduciary, fee-based, markets work, do the right thing kind of philosophy is really taking off. I think in Canada, is one of the laggards globally in this space. So it's nice to see that the respect for the quality of this kind of framework is really taking hold. So love talking to people about that. We're super passionate about it, and we do want to have a great impact in the Canadian marketplace.
Yep.
Cool. You good to go to the episode?
Let's go.
All right. Okay, episode 321. A few weeks ago, we welcomed Håkan Cobley to the pod, and I thought that was a great conversation and super thoughtful person about allocating assets inside a family office environment. So he's the CIO of the Reitan Capital Group in Oslo, Norway, which is a family office. And in that episode, he talked about how they think about managing money for the Reitan family in Norway. And he was discovered for this role by Magnus Reitan, who is a third-generation family member of the Reitan family, obviously. And I had a chance to go to Norway last week, met Håkon in person and met Magnus at this event, which was a truly amazing trip. Norway's gorgeous. Obviously, it's a phenomenal country, very, very interesting. But earlier this year, Håkon had reached out to actually both me and Ben to see if we could go. And it's easier for me to travel to Norway than it is for Ben, obviously. So I took the opportunity to go. So Lisa and I went. And their objective in the family, as Håkon described on the podcast, and Magnus is coming up on the pod in a few weeks, which will be so interesting. He's such a great guy. Very, very kind, thoughtful person. But they want to start creating this center of excellence around portfolio management, construction, implementation, asset allocation, expected returns. But they wanted to create this center of excellence in Norway in a supplier unencumbered environment, so no pay-to-play environment, which you got to hand it to them, right? To basically share what they're thinking and get people together that have different points of view. I think hats off to them for doing it, because it was a phenomenal event. They had 100 people there that flew up to Trondheim, mainly from Oslo, but Trondheim's a short flight. But it is a bit out of the way. Beautiful, beautiful city. And so they had it at their, they have a, wow, I don't know what you call it, this incredible set of buildings, kind of a compound that they've restored. It's a 1,400-year-old compound in Norway, if you can believe it. They've completely renovated. So it's a beautiful facility to have an event like that. And this is the first time they've done this, so we'll see where it goes in the future. I said if they have it next year, I said Ben would be great to have Ben join them. That was my suggestion to Håkon. Anyway, so there's 4 presentations. I thought today I'd go through my presentation, and you and I can just riff off that if that sounds cool with you.
Sure, it's great.
But get this, so the lineup was Antti Ilmanen from AQR, who is just had a chance to have dinner. We had dinner, all the speakers the night before. Antti is just such a nice person, very, very thoughtful. So he was our guest back in episode 202. He talked about expected returns. And then Håkon also invited Professor Marcos Lopez de Prado, who is a prof at Cornell, but he's based in he's in Abu Dhabi. The Abu Dhabi Investment Authority, ADIA. And he presented on machine learning. I tell you, Mark, I understood maybe
I was going to say
10% of the presentation, and that 10% blew me away.
No kidding, eh?
Where this is going.
Have you read Antti's book? What is it? Is it called Expected Returns?
Yes, I read the book. It's a phenomenal book, and he's a very good communicator. Yeah, he was at sidebar. He was at Chicago with Cliff Asness, same time. Cliff's a bit younger than he is. Yeah. So he was close to like Fama and French, and so he's part of that gang from back then. Also presenting, get this, was Eric Hilda from, he's the global head of external strategies at Norges Bank Investment Management. So that's the Norway Fund, the famous Norway Fund.
Oh, wow. Yeah. And you guys have talked about that on the podcast as well, the Norway Fund and their model, right?
It's so fascinating. They're so huge. The
trillion something? More than that?
Almost $2 trillion.
Wow.
And they put 3% of the fund into the treasury of the government each year. No deficit, no debt. And that 3% makes up 1/4 of their spending each year in their budget. It's just an amazing story.
Wild.
So we talked about how they choose active managers as part of, I think it's a 5% portion of the portfolio, but it's not, they're not doing large cap U.S. managers. They're really going off the beaten path, and how they do it is absolutely fascinating. They don't look at performance numbers. They go out on the ground, meet the managers in kind of off the beaten path areas of the marketplace. A really, really interesting guy. Very good presenter too. And then the whole event was hosted by Katie Martin, who's from the Financial Times, and she was wonderful MC and moderator. So it was a great event. So
quite a lineup.
That's the setup, and they asked me to come to be obviously non-academic. Shocker.
Yeah, nothing personal, Cameron, but I don't know that you have much to add to that lineup from a pure academic standpoint on markets.
It's a very, very humbling experience to speak alongside them. But I had a different role, right? Håkon asked me to speak from a practitioner standpoint and what it's like being a practitioner kind of concurrent to this revolution that's happened, going back to Markowitz and Sharp and whatnot. So that's what I talked about. Then he said, focus on investments and then kind of take a handful of kind of key episodes and distill some of the messages. So I thought we'd kind of run through that.
Sure.
So I think, as I've said many times, this revolution that has happened, which is, I think, has been illustrated on this podcast, the people and the work that has gone on for decades in this space, to me, is simply mind-blowing. Mm-hmm. And we've heard it from whatever, up to now, 160 guests or something, right? It's truly inspiring. And even with that, so many people aren't even aware that this is going on, right?
Well, I mean, that's just it, right? Like you call it a revolution, but like, and you're right if you know about it, right? But like, especially in Canada, like and again, I think the Rational Reminder podcast has done a good job of bringing those people together and opening other people's eyes. But like prior to that, it just wasn't obvious that all this research and academic work had been done to a lot of, like I was in the industry for a decade basically, or not quite a decade, about 6 years before I really even understood what index investing was, you know what I mean? Let alone, factors and everything else. So it's, I agree, it's picking up steam, but there's just still a ton of work to be done.
So do you know when the light bulb went off for you?
For me, it was 2015, and it was because of Dan Bortolotti and Justin Bender and the writing that they've been doing online, right? And I think any captive advisor in Canada is, for the most part, been trained by the institution that they were hired for, rather. And so your learning is all top down from the company that you work for. And like, unless you're very, very curious and want to seek outside sources and believe you have a reason to do that, it's like you just might not stumble upon it, right? Like, I mean, I know advisors have been doing this for 30 years that think indexing's a marketing ploy of some kind. And so I stumbled upon the Canadian Couch Potato blog and started reading it, and it just blew my mind, and the penny dropped right there and then. And I think I've talked about this when I was on as a guest before joining PWL, but I took effectively my entire book of client assets, which was close to $300 million at the time, and I converted it almost 100% index funds, like within months of understanding how it worked.
It's interesting you use the word curious, because I think that is one of the common threads of people that embrace this. Because it's easy not to embrace this in the industry. Very easy. And there's lots of messaging, lots of reasons not to, including compensation, right?
Well, it's hard to sell people on the idea that something so simple and elegant can actually work so well. And I've written about this before, but people love, and you've talked about it too, but people love stories. They love narratives, right? And it's very easy to craft a compelling story about companies and allocations to different countries and different asset classes that sound really good and are really easy to buy as a consumer. But it's like, no, you don't need any of that, and you just need to own all the companies and keep your costs low. Like, that's actually a really tough pill for a lot of people to swallow. And so it's actually, I think, more difficult to sell people on the concept of index investing, let alone say factors, but index investing alone. I think that's harder to get across to people than a good story about a fancy portfolio.
I agree. So I'll get to my aha moment, but I started my presentation. I threw up on the screen a slide of us on the interview, the YouTube picture of us with Eugene Fama. I remember that day. It was Good Friday, 2022, which of course anyone knows Eugene Fama's work ethic. He works every day in the mornings, every day, and he has since before I was born, and I was born in '66. So we're talking a long time. We're working every single day at this. And classic Eugene Fama, meet me on Good Friday morning, right? So I just remember kind of being in awe. I wasn't nervous. I was nervous for Cliff Asness' interview, but I wasn't nervous. I was just how do you get to this point, right? So I started by saying, we're all here in this room. We're all working for families at some level. We're more on the retail home front. They're more family office type allocators from across Norway. But I said, we're all here for a reason, because we care. And to your point, we're curious. That's why we're here, right? I told the story of growing up in small town Quebec. I'll post a picture here that we're going to put in the video. But I grew up in small town Quebec, and from an age of 10, I worked in a butcher shop, which I absolutely loved. So I worked with these two guys, and if you're on YouTube, you can see the picture of the two guys I worked with for years, from when I was 10 to 20. I was just a little kid going to this butcher shop, right?
Yeah.
And I think back to those times now, and maybe I'm picking up strings here that make no sense, but there's things I learned in that butcher shop, even at a young age, things like take care of the customer, Try to learn as much as you can about the product. Like they had me at age 12, I was serving customers meat at the counter. I mean, now you never let a 12-year-old do it, right?
Right,
but
yeah.
Serving customers and knowing how to do the right thing for customers and not screw them with a piece of junk meat or something.
Mm-hmm.
But I also learned price is clear. We used to go into the cooler on Saturdays at noon and see what we had a lot of because we were closed on Sundays. Whatever was there had to go. Mm-hmm. So, of course, you adjust the prices to clear. Well, think about that on a market standpoint.
Yeah.
Every trade's got to clear. Every stock, every buyer's got an incentive to want to buy that stock, which leads to expected return, of course. Mm-hmm. So that whole experience, I think I look back, like we're all working in a butcher shop now, take care of people and markets work and prices clear. So I started off by telling that story, which seemed to resonate. And then after I graduated, got a job. People have heard the story. Got a job selling beef. Realized I was just basically a quote machine for a commodity. Wasn't adding a lot of value. And this was back in the David Chilton era. Mutual funds were hot. Wealthy Barber in Canada. And I think Canada created the back-end load commission. So I started selling back-end load commission mutual funds. Mm-hmm. Quickly realized that wasn't right. That didn't feel right.
So back-end load is DSC, is it not? Back-end load is basically
DSC,
where, so you buy the fund. There's no commission to buy as a buyer of the fund, as a client, but you're effectively locked into that fund for usually like 5 to 7 years, I want to say, and there's a declining commission on it, so you can't sell without triggering a commission, right? That's what back-end load is. Yeah.
So you put in $10,000 into a mutual fund, and we would make between $500, $600, $700 commission. As long as the clients held it for 7 years, they wouldn't pay the commission. Mm-hmm. We never talked about expense ratios, but you look back, I mean, the MERs were well north of 2, some were north of 3, but we never talked about it, never trained on it.
Yep.
So you didn't know, but I ended up at a Cheers bar in Fidelity. I went on a due diligence trip to Boston. Ironically, Ben's in Boston. Mm-hmm. And ended up at the Cheers bar with a Fidelity executive and said, if you don't go fee-based, you're dead in 5 years. This was 95-ish.
That's what they told you?
He told me that on the side. We were just chatting at lunch. Mm-hmm. So I came back to Ottawa, afraid for our business. We got to go fee-based or we are dead.
Yeah.
So that's when we met our current friends at PWL Capital and joined in 1996 to go fee-based because they had an independent fee-based platform in Canada. And then, a good friend of mine who was at the firm then, Keith, because we used to pick managers, and I get so frustrated because you pick a manager and they would quit or go to a different firm. It's so exasperating, right? Mm-hmm. And Keith said, well, you can have this all go away by going indexing. And we had been trained, Mark, to defend ourselves against indexing.
Yeah.
It's crazy. In hindsight, it's absolutely crazy, but we were trained about that.
This is 96, did you say?
96. So ETFs were just starting.
Yeah. The first one was launched here in Canada, was it not?
Absolutely.
Yeah.
Yeah, we beat the US on it.
That's right.
And so that's when we really got into ETFs and Keith wrote a book on it, The Empowered Investor. This is our good friend Keith Matthews. And said, it all go away, and you're fee-based, you're paid by the client, no matter what the product is. You're kind of product agnostic from a comp standpoint. So look at index funds. And it's just like the light bulbs just went off big time. I was like, you mean all this manager selection nonsense in a retail environment can go away? Yes, it goes away.
Yep.
So it was an amazing epiphany for us. And this is just the industry was getting going. Meanwhile, back at the ranch, this is after the Fama French famous 3-factor paper of 93. Mm-hmm. With the factors that explain expected returns on portfolios. This is long after Sharpe. This is long after Markowitz. Long after the CRISP database. Long after computers arrived at University of Chicago and other universities, of course. So we had this explosion of technology and data and brain power to start figuring out how markets work. Like this was going on just as I was discovering indexing.
Crazy.
And it just became this eye-popping experience of curiosity because at the time, and people have heard this story as well, this is before Google, right?
Yeah, of course. Yeah.
So you go to the library, start picking out books. I found like Larry Swedrow's books and William Bernstein's books and our friend Dan Solin's books, and you kind of dig into this world. It's like you just learned about all these names, Fama, French, Sharpe, Markowitz, and it goes on and on and on and on. It's just like this candy store of ideas that you could bring back to your financial planning practice, right? Like a butcher shop, just do good service, do what's best.
Yeah.
And so that's the story I started telling at the at the event. So I obviously left the selling the beef commodity business and set up a financial planning practice, learned about this revolution, joined PWL, and then just kind of kept a head down and kept taking care of people, and here we are. But can you imagine what it was like to be in the scientific domain of science of investing back then? It must have been wild. I mean, Fama called it fish in a barrel to find stuff.
Well, I think for anybody who's seen Tune Out the Noise, which is the documentary about the founding of Dimensional in a lot of ways, but also about that era, right? And the documentary I thought was really, really interesting, specifically those scenes, right? Like this was a new science back then. And the fish in the barrel analogy was because it's like the things that we take for granted today, the information and data that we take for granted today, they were building it back then. So there was just every question you can think of today that has a very well documented answer about markets. Those questions hadn't really been asked, or they'd been asked, but they couldn't be solved back then. And now they had the data, the computers, the brain power to start looking at these questions, right? So it must have been, they must have just had a lot of fun, right?
Oh, it must have been a ball. And it's still remarkable to me that some of the basic concepts, markets work, diversification is your buddy, risk and return are related, those basic foundational blocks still by many people aren't appreciated today.
Yeah.
Let alone a lot of the things that we've covered off with the academics that we've had on the podcast.
For sure. I don't know how much attention you paid to the U.S. election as we were coming into it the other day, but everyone was glued to the betting markets.
Yes.
And Poly Market and a bunch of other ones. And
yep.
It was just really fascinating to me to just watch how much stock people put into those betting markets as being predictive of the outcome, because those markets are allegedly efficient because it's the wisdom of crowds. But how few people believe in market efficiency at the same time, right? It was just funny to me that it's like you believe in the betting market is relatively efficient, but you can beat the market picking stocks at the same time. It's like the cognitive dissonance to me was just fascinating to watch.
Yeah. So I went from telling that collection of stories and then jumped into talking about a bunch of podcast guests. It kind of stood out to me. Of course, I picked some of the bigger names that we've had on for a little bit of impact. But the first one I want to talk about there, and still it's an amazing interview to me, is our conversation with Nobel laureate Professor Eugene Fama. I mean, he was, first of all, he's super gracious, very kind. I think got 61 questions in with Professor Fama.
Wow.
If anyone has not listened to it yet, it's a must-listen interview, of course. And some of the highlights that I took away, one is markets are efficient. He said stock prices reflect all available information, making it tough to consistently outperform the market. He's very skeptical of active management, argues most managers don't outperform passive strategies after fees. In fact, if you want to participate in the markets, what you want to get rid of is the bad active managers, because they can actually make the markets less efficient. I find that really interesting, right? And if over time the bad active managers kind of fall away, it makes the markets even harder to beat, because what's left are the great managers.
Yep.
It's a fact of life that you will not get a precise number for expected returns. Same goes for factor premium numbers. He says you may have high long-term expected returns, but they're not certain. Never forget, back to my point earlier, markets always have to clear. Every stock must be owned, so the price paid must be good enough to entice the buyer. He does not know how to advise on private equity. Gene Fama doesn't know how to advise on private equity. I think there's information in that statement. Asked him, why would you deviate from a market portfolio? And he said, taste, simply as taste. If you have a different tolerance for risk. And then lastly, my other point takeaway was 90% of the investment industry's research is marketing.
And people don't, it's not deceitful, that's not the right word, but it's disguised in such a way that I think a lot of people don't realize it's marketing. That's the tricky part.
Yeah, and often in many cases they're selling a story that people want to buy. Let's face it, there's great stories, right? And everybody wants to outperform. So
at the previous firm I worked for, I tried to introduce them to indexing. They were big on the traditional active managers, pick the best managers, and forget about the MERs, it doesn't matter. When I tried to introduce them to indexing, they were like, no, that's just all marketing. And it just blew my mind that for almost 30 years, they'd been fed marketing from big active fund companies and thought that was data, but thought indexing was marketing. They had it completely backwards, and I kind of just stopped discussing it with them at that point.
That indexing was marketing?
Yeah.
Okay.
Yeah.
The next interview I highlighted was our one with Ken French. Again, another must-see episode. He talked about how asset pricing models try to give us expected returns. However, the actual return is made up of expected and the unexpected. He really talked a lot about the unexpected return. The unexpected can absolutely swamp the expected, and many people draw way too many conclusions from the unexpected. And for sure, you see that all the time. And so few years deliver the expected return, which is also an interesting stat. Premium for small value has been more reliable than the market premium. Institutions drive way too much activity based on 3 to 5 years of data. There's so much wasted energy. Mm-hmm. Ken never argues that prices are right. He does not know which ones are too high and which ones are too low.
So I think that's such an important point, right? Like if you're discussing market efficiency with people, it's not that prices are always right. It's that you don't know when they are and when they aren't, right?
Right. And for the value factor sort, he prefers book to value as it is much more stable and thus has fewer transaction costs.
Did I tell you I met Ken French at the conference? Was it last year? I guess it was last year. He had just finished the talk, and then he was out grabbing something to eat at the buffet table, and he was just there by himself. And I was, I think, making a phone call or something to my wife. It's like, I gotta go meet Ken French. She's like, who? Click. And I ran over to the table, and I was just really nervous, and I didn't know what to say. And I kind of just told him I was a big fan, and I don't think I impressed him that much. He just went back to picking his buffet food very quickly.
Yeah, he's a big, great guy. Yeah. Next one I highlighted was our conversation with Nobel laureate Robert Merton, who, on a personal note, I thought he was the kindest guy ever. I mean, this is Bob Merton, right? It's contributed so much to financial economics, and his work in the 70s on options pricing was so important in so many different fields of business. It's incredible what he's done, but he kept on apologizing for long answers. And I'm like, you're Bob Merton, we'll listen to you all day long, right? Besides, maybe I'm talking and rambling on here too much to your audience. But he made a lot of great points. Number one, markets get trades done, and they also provide information. The market is a vital source of information. When you trade, you must ask yourself, what information do you have that is better than the market, and what information does the market have that is better than what you have? That is, to me, very profound. And there's, $700 billion of trading done every day?
Every day.
There's a lot of information in that.
Yeah.
When you trade, you must ask yourself, I just did that one, sorry. Market efficiency has been tested for more than 50 years, and it's hard to beat. You need to define what your risk-free asset is, and it is likely something different for each of us. This next one was my biggest takeaway, and I think about often. Stocks are risky over the long run. In fact, the risk gets larger over time. Sure, the average return might be stable, but the law of large numbers can bite you at the wrong time. The idea that you are assured a high return over the long term is dangerously wrong.
And people have a tough time with that one, right? I think over the long run, people think stocks are safer. But what you're talking about there is the potential for the wide dispersion of outcomes, right? Because they're volatile, you don't know what the returns are going to be, and over the longer the time horizon, the wider that dispersion gets, right?
And you can go blow up in the last year or something, depending what your time frame is.
Yep.
And very few people have perpetual time frames.
Yep.
Right? The risk-free asset pays me when I want to get paid. We also talked about financial literacy. And he says, always try to make it easy for people to make decisions. Teaching financial literacy is hard and might not work. That kind of flies in the face of what Anna Maria Lusardi talked about which I don't know who's right, but I find it very fascinating. So he's all about having easier decisions for people to make for their financial decision making. Another one that stands out, and I've learned to appreciate more, I've listened to several times since then, was economist John Cochrane from the Hoover Institution. I mean, John's a brilliant mind, brilliant communicator. But you got to pay attention to keep up with what he's saying, right? If you remember.
Yeah.
First thing, price changes reflect lower discount rates. Stock price increases are often due to lower discount rates, not necessarily higher future cash flow expectations. Higher valuation ratios predict lower long-term returns. High price to earnings ratios generally predict lower future returns over long horizons. However, he's unable to capitalize on this reliability from a market timing asset allocation perspective. So it's about these ebbs and flows of returns. If you go through a period of higher returns, you should have expectations of lower returns going forward. And these cycles happen. That's his point. Expect return. Go ahead.
Sorry, I was just thinking about this in another way. Like this morning, I was walking back from dropping my son off at school and just thinking about what the markets have done this year. And then again, yesterday after, we're recording this on the 7th of November, and yesterday markets just went on an absolute tear after Trump was declared the winner of the election. And when you think about long-term average returns, and you think about years like this year where markets are up, 20, 30, 40%, depending on what you're looking at over the past 12 months. And you have to kind of think like, do I expect the market, if I was expecting the S&P to compound at 10% indefinitely, do I expect it from here, like from this point, 10% from here, when the market has just gone up just so unbelievably much, right? So it's, to your point, it's hard to capitalize. Like, what are you going to do? Time the market now and say it's up so much, I'm going to get out? Like, what if it does compound from this point at 10%? It's such an impossible, it's such a difficult decision to make as somebody who has to think about their own money, right?
Yeah, and if you get Fama that says you should expect a real return, something like 4% on stocks, something in that zone, a lot of people are coming out. I think Goldman came out and Antti has used this number as well. Like real returns on U.S. markets could be the 3-ish real over the next decade because we've come through a period of such great returns. We've also come through a period where interest rates have fallen on average over the past 20 years. Well, the cost of borrowing is a lot less for companies, so that helps their P&L. So you can get and if risk appetite goes up, you can get great returns that have happened with lower returns going forward because of those phenomena. But as Ben talked about in one episode, to continue to expect the PE multiples to keep expanding, it's a tough assumption to make, right? But a lot of people are throwing in the towel on global diversification. So that was one of the things they talked about a lot at the conference last week. John also talked about how market predictability doesn't equal inefficiency. Predictable long-term returns don't prove market inefficiency. They simply reflect rational responses to risk. So interesting. And risk management is key. Investors should focus on managing risk tied to their unique circumstances rather than seeking short-term gains or market timing. And he also said it's very hard to ignore the risk when the markets get cheap, even for smart long-term investors, because there's always a story. When markets go down, there's always a story as to why. So we can say, I can take a 25% market correction, no problem. But it's always connected to COVID or a plane flying into a building or a debt crisis or a tech bubble or some other event, right?
Yeah, I call it the hard right edge. When you're at the hard right edge of that graph and you don't know what the future looks like, it's so easy in hindsight to go back and be like, I would have bought here, and I would not have been scared during 2008 when markets were down 50%. But when you're going through it and you're at the hard right edge of the graph and you don't know what's coming, people feel a lot differently.
Yeah. I then talk quickly about Antti Ilmanen's key points he gave to us when he was on the podcast. Again, another must-listen episode. Historical data can mislead. Long-term historical returns, while useful, can be distorted by big valuation shifts, like we were just talking about. The equity boom in the U.S. has been unbelievable. Forward-looking yield-based estimates provide a clearer picture for expected returns. Low expected returns are here. U.S. markets show low expected real returns in the 3% range due to high valuations. Investors have bored returns in the future, he said, locking in a low return environment. Any contrarian strategy needs patience. He talked about this at dinner, how he acknowledges that He is a contrarian, but you do need to be patient, especially with value strategy. We've talked about a lot, right? Value underperformance lately. Value and contrarian investing are hard to time. They can be profitable in the long run, but often require long periods of patience, as shown by the U.S. markets overvaluation. I mean, you talk about yesterday. Do you see small value? And I know this is one day. This is simply an observation. I'm not. Like, small value is up 7.25% in the U.S. yesterday.
Yeah, it's wild. That's
wild.
One of the better days
so
I've ever
fast,
seen.
right?
Yeah. Well, and that's just it. Right? I think those factor premiums come out of nowhere, and you need to be in your seat to capture them. And yesterday was just one of those days, right? And there's somebody on Twitter posted just like, don't get too excited about it, right? And I was like, no, please just let me have this one day. Like, come on, let me enjoy this. Yep. Yeah.
You want to talk about illiquid assets not being as profitable as expected, despite their popularity. Illiquid assets like private equity and real estate may not offer larger premiums investors hope for, often delivering only modest returns due to their appeal of smoothing service, the volatility laundering that we've talked about before.
Yep.
And some people are willing to pay extra for that.
And
then from a personal planning standpoint, lower returns mean a higher savings rate. Expect returns down. Individuals need to save more. A 2% drop in expected returns can nearly double required savings rate.
Wild.
Yeah. And then lastly, I talked about the time we had Professor Ludovic Phalippou on to talk about private equity. That was, I thought, one of the great interviews. Mm-hmm. And kudos to Ben for getting Ludovic on. I mean, he was, great guy, very articulate, and talked about private equity, because we get asked that often about private equity. And he highlighted a few things. Number one, private equity involves complex terms. Institutionalized private equity refers to third-party investment in private companies, which is very distinct from personal ownership. There's great challenges in measuring returns. Private equity lacks standardized measures like public equity does, making IRR calculations misleading. I would argue most people don't understand how IRR works and how it can be misleading.
Just that discussion that you guys had with him around how IRR works was, I remember I was driving from Squamish to Vancouver, and it's a long, winding highway drive, and I was listening to that episode, and just that part on IRRs was mind-blowing to me. Yeah,
and how if you bank in our IRR early in the life of the fund, it kind of carries with you.
Yeah.
For a long time. Talked about fees as well. High fees are common. Private equity funds can typically in the end charge around 6 to 7% in fees. I think some would say it's lower now because returns are lower, and a lot of the returns are based on the carry. So there's some debate around that, but the point is the fees are high, and pay attention. And benchmarking is tricky. Comparing private and public equity performances requires careful industry and geography adjustments. So those are the ones that I highlighted, and these are kind of the hot topics that were discussed in the room. So I thought it ended up coming across okay. I would hope that Hawk and Magnus were pleased with it. But my key takeaways for them in terms of a community looking to create this cluster of excellence was, there has been an unbelievable revolution, and so many people, pros and amateurs, are completely oblivious to this revolution. And so much of this industry, I think you'd agree, can't afford to embrace it because it could be business suicide if you do.
I think that's true if you go about it the wrong way. A good friend of mine asked me about this recently, and he was having trouble with basically doing an about face with his clients. And I've worked with doctors for a long time, and so I tend to use analogies that resonate with them. And I told my friend, I was like, well, think about it if a doctor came across a new procedure, or maybe it wasn't even a new procedure, it was just an old procedure that just had better health outcomes for their patients, but they didn't know about it before, and now they know about it. You would expect your doctor to implement that procedure if you knew that it was going to have better health outcomes, even if it had been around for decades and they've been doing something else. That's what you're hiring good advice for, right? And so I think if it's not about saying I was wrong all these years, it's about saying now I understand this better, and I think this is a better solution, and I'm going to implement it for clients.
I obviously agree, but most people, treat their doctor with great respect and wouldn't challenge. Many people would challenge you or I on active or passive. They do it every day. Else, right? So it's a little different dynamic. I would argue back.
Sure.
Well, obviously I agree. Of course you got to do if you learn this information.
Yeah, because what's the alternative? Is you learn it, you know it's better, and you don't implement it for your clients?
I don't know. if you're kind of on the sunset of your career, it's a lot of work, a lot of explaining, a lot of business risk.
Yep. But you got to live with that, right? You got to live with you got to live with the idea that you know there's a better way, and you've, for selfish reasons, decided not to do it.
I also told the group, I said, you need to be immersed. So I plotted them, and I hope they create some sort of hub of excellence. I said, in my opinion, you kind of need to be immersed in people that want to think and learn, are curious about this stuff, and can share ideas. So I thought it was just great that you have this, 100 or so people from all kinds of different organizations, different family offices. If you can come together to share best practices, I think that can really help the learning, the appreciation, because this stuff is hard. And if you can share off each other, I said that'll be very good for the group. And I said it's also super fun, right, to be curious about learning, and there's so much to learn in this space. And it's hard. It's hard. So if you can get, safety numbers to do some of this work, I think that's a great thing. I also said it's great fun to see people change their minds and to become enlightened. Like the epiphany you and I have had. I mean, it's fun. It was fun for us. It's fun to impart that on others. It's fun to see others kind of have an aha moment as well. And it's also important to quiet the noise. You quoted the movie, right? Just to cut the noise. I mean, I go back to 95 when that light bulb went off when Keith told me, I don't have to worry about all these active managers.
Yeah.
Like, think of the noise. It goes away.
Well, and the ancillary benefit to that is you don't have to spend as much time talking about markets, right? Like if you're on board, you get what markets give, and it frees up all of your time to do the really important stuff, right? Like the financial planning and the behavioral management and everything else that really moves the dial for a lot of people. Whereas I remember before, when you're picking active managers and looking at performance, your meeting with clients is largely taken up by defending the performance of the selection of managers that you've chosen for them, whether it's good or bad. And it's just such a waste of time. And in hindsight, it blows my mind that people paid me to do that, when I could have been like, oh yeah, market's up. Oh, I didn't even know. Like, great. I saw it on Twitter. Cool. Now let's talk about retirement, financial planning, and tax planning, and that gift you wanted to give your kids and everything else, right? So I think it has it can kind of multiply the effect of not only tuning out the noise, which makes the investment side of things easier, but also sort of accelerates the benefits of spending the time on the other important things like financial planning.
And think of the progress. Like, I think back to the butcher shop, the competition, right? We were down the street from a big national chain. We were just this tiny grocery store, but we would compete, right? That made us all better. And the competition drives progress, better service, better product, better prices, and all these things. And this happens every day all around the world for thousands of companies with millions of employees. And then on top of that, you've got a market pricing the value of those companies hundreds of millions of times a day. I mean, it's an incredible adaptive system globally. I mean, it's just, when you think about that, it's absolutely mind-blowing. All the analysts and all the towers and all the cities all around the world, it really is an amazing, amazing system of progress. So by embracing this philosophy that markets work, you kind of go along with this. And my last message was, unintended consequences will rule the future. You don't know the benefits you're going to get out of this, much like we didn't know the benefits from starting, Ben's YouTube channel or this podcast or Money Scope or whatever other endeavor we've done. You never really know what's going to play out. Like, one of the biggest unintended consequences that we had was finding phenomenal talent, like how we met, right? Like, we didn't plan this, and we started it so many years ago. Unintended consequences, call it luck, call it whatever you want, will rule. So I said to the group, I said, you don't know what you're going to create here, but it could be pretty cool. And that's where it went. It was super fun.
Oh, that's great. Yeah. Yeah, and a cool place to do it too, eh? Norway. I mean, obviously they're from Norway, the organizers. That's why it was there. But it's cool for you to get to go specifically to a place like that to.
Have you been to Norway?
With these people. No, I was in Sweden this summer because my sister-in-law lives in Sweden. I was in Stockholm, which is a beautiful, beautiful city. So that's about as far as I've gone into the Nordic countries, so to speak. So
we started in Oslo, and we stayed in a hotel right off the main square by the train station. And the first thing you notice, and as someone with tinnitus, I really noticed it. It's quiet. It's so quiet. They have the highest proportion of electric vehicles. The public transit is, as far as I could tell, all electric. Wow. It is so quiet. It is fantastic. And the other thing is they of course love their saunas or saunas, however you pronounce it.
Mm-hmm.
And in one of the fjords that come into downtown of Oslo, by this beautiful modern art gallery, spectacular building right on the water. But across the water might be, I don't know, 50 meters or something. There's a bunch of floating sauna huts.
Oh, yeah,
People
right.
are going in the sauna and then doing the cold plunge in the water, which is like 9 degrees year round.
Yeah,
And it's
yeah.
right in front of the art gallery, and you can rent like the sauna. These are public saunas.
Yeah.
So cool.
What time did it get dark there? You were just there, right? So
Yeah, it got dark. 5:30. It wasn't that different than here, and it looks similar to here, similar trees and stuff. But it was
Yeah.
it was just beautiful. And we did a nice boat tour, and the landscape is spectacular. It's
Wow.
just astonishingly beautiful place.
nice. Well, next time I'm
people are
in that
great.
part of the
Food
world.
was great. We loved everything about it. And then we flew up to Trondheim, where the event was, and that's like 500 kilometers northwest of Oslo. Again, right on the coast, well, inland a little bit, but again, a lovely city with beautiful waterways, and it was a little rainy and damp when we were there, which was to be expected.
Mhm.
But again, it was fantastic. We got to go back. We didn't make it to Bergen, which is on the west coast, which apparently it's the spectacular scenery in the fjords. We didn't know. We didn't pay good enough attention, so shame on us, I guess.
No, next time.
Next time, yeah.
Nice. So I've got some questions for you.
This is the after show, I guess, right?
Oh, is this the after show? Sure.
I don't know.
I
We're
guess it just
chatting.
started. Yeah.
A couple of guys chatting. Maybe there's the 3 people left that are listening. We'll see.
I think we're up to 4 now because somebody told me they're the 4th after show listener. So
That's nice.
yeah, our
Well, maybe-
ratings must be going up. I
Maybe
don't know.
without Ben, this is so bad they bailed on us. Might be down to 2.
No, that's true. That's just maybe there's nobody here. Who
Maybe
knows?
just Ervin and Jason are left. Might be just them.
Irvin and who?
Jason. Have you heard of Jason?
Never heard
Pereira?
of him. Never heard of him.
I think that's his name, right?
Something like that. I don't know.
I think it is.
So it still blows my mind that you were getting into that type of portfolio management and thinking about markets as early as you did. Because like I said, I think a lot of people spend their whole careers not, and just never kind of stumble across it. So it still is really fascinating to me that this was happening for you back in the middle of the 90s. But I want to go back and I want to think, like thinking about your career and where you are today. Because as you mentioned, we talk to advisors all the time. People on LinkedIn reach out to me all the time, new advisors, people thinking about getting into the industry. People have been in it for a little while, trying to figure out their way, big fans of the podcast. So they are kind of stumbling upon this revolution that you've discussed. But what would be your biggest piece of advice to somebody who's just getting started in our industry with what you know today?
I mean, there's so many facets to that, right? Like, there's from the actual, what are you going to deliver? What's your investment philosophy going to be? You better make sure you've got a good one that's robust and can stand the test of time. And that, to me, speaks of quality. So you better get one, and you better get it early and spend some time trying to understand that. If it's different than what we're proposing, I have a hard time, given all the work that we've done, embracing something else. But maybe there is something else out there that works for you. But as David Booth says, have a philosophy and stick with it, right? So that's from an investment philosophy standpoint. But it's also from an industry standpoint, understand what you want to do. Because as you know, working with clients, you're carrying a lot of relationships and commitments, in your head, and they're always there, right? So it's not a typical 9-to-5 job. I think you'd agree.
Yep.
Like you're invested in these people. And these are people with real issues and real families and kids that want to be educated and parents that got to take care of and insurance needs and all kinds of stuff going on. So you have to, I mean, it's a wonderful thing to bring your A game as much as you can, but it's not like a light switch type job where you can't mail in this job. So
No, you're in it or you're not, right?
And my other advice I give to people is to really understand the firm that you're in. Like, understand, are you part of a team? Are you a siloed? What's the ownership like? What's a long-term plan like? And I think a lot of people don't spend enough time understanding that to make sure there's a good philosophical fit. And maybe it takes time in the boat to get an appreciation for that. But have lots of conversations with people about that.
Yeah.
What would you say? Biggest piece of advice you give to people?
That's a good question. I wasn't expecting to have to answer that. I think you hit a lot of it. I think philosophy matters, and I think you can kind of you can fumble that very easily because again, a lot of advisors that get into the industry are kind of trained from the top down within the organization that they work for, right? And so without that sort of innate curiosity to go beyond that, and then some firms are great and they're teaching the right things, but many are not, unfortunately. So the kind of stumbling upon your own investment philosophy, I think often even that part can be difficult because in a lot of ways you start in sales almost, right? And so you're selling the story or the product of the firm that you work for. So the investment philosophy is important, but don't be discouraged if it takes a while to get there. Like if you're already here listening to Cameron and I discuss this, you're probably well past this point, I think, right? For the most part. I would say somebody getting just into this industry, the most important thing for me was my network. And like you and I wouldn't know each other had I not started writing on the internet a while back, I think. And that, I wrote on Twitter because I didn't know how to build a business. And so I just started writing on Twitter. But the major benefit that came from that I didn't expect was I developed all these incredible friendships with other advisors. And other people, not just advisors, but accountants and other people in our industry and sort of tangential to that industry. And I've created these friendships and this network where, I joked with my wife the other day that I'm kind of at a point now where if you ever fired me, Cameron, I can go get a job tomorrow because I've made all these friends in the industry that would, gladly take me on. And that's such a huge benefit, not only because it gives you kind of safety, but also because there's so many great people to learn from out there and so many different perspectives. And if you're just kind of operating in a silo, you just might not realize how big this world that you and I operate in is, and you might not learn a bunch of great things that you could have learned early on. So I think developing your network in the early days is a huge boon.
I love meeting new people.
I know
in this business. Like when I reached out to Larry Swedrow back in 98 or 99, again, just found his email somehow because that's pre-Google. And he offered to come to Ottawa 3 times to speak for us. I mean, and it wasn't for money. We made a donation on his behalf and took him whitewater rafting. It's just an unbelievable. Look at Dan Soul and the relationship we got with Dan. That you got this book coming out, which I want you to talk about after, perhaps. But I reached out to Dan around the same time. He's become a very dear friend of mine, and just spent time here in Ottawa. And it's at the meetup there, the podcast meetup, and just a wonderful person that had you not reach out. But we're all trying to, again, we're curious. We want to help people. And the more we all come together in this community, the better it is for everybody. Yeah, no, absolutely. Does your answer differ to those who are kind of later in their careers? Like what? Later in the careers, my belief is empower G2, the next generation advisor. I mean, as you know, we have an incredible team here. We have an incredibly young team, talented, highly credentialed, and kind of get out of the way and help the next generation really make a difference. Let them have impact. Mm-hmm. I hear many stories where that's not the case in organizations, and they're kind of kept under wraps because they're too young, right? They don't know what I know. It's like, well, I don't know, man. This team here is pretty good, and like they're highly credentialed, highly capable, highly skilled. And they've got the reps and the client meetings and the ability to have great conversations and take advantage of some of the tools that you've helped build, that Braden has helped build with Ben, and this incredible team of thinking. It's like get out of the well, not just get out of the way. That's not the right, because that sounds like abdication, but help them become what they can become and let them run with stuff, right? And that would be my main piece of advice. And it's never too late on the science investing side. It's never too late to learn, like you said earlier. But there's a lot of really good, young, smart people in the industry. No, I'm not just talking here, but in the industry's lots of great people. No, I know a few that, even coming to PWL, right? Like I thought I was a pretty good planner, and then meeting some of my now colleagues, they're just freakishly good at what they do, and I learn a ton from them every day, and that's impressive. And you add a ton to them every day, right? Maybe a couple things. So I think you kind of answered this, but so if you could go back now to when you started, and you did kind of get on this horse pretty early in your career, but if you could go back to the very, very beginning, is there anything you would have done dramatically differently? I don't know, man. It's been super fun, right? Like, I mean, I regret not knowing about the science of investing. I'm kind of embarrassed because I'm sure I studied Fama and French in university in some economics class. I know we studied Sharpe and risk, and I know Markowitz was in there, but I wasn't bright enough to draw the line between, my undergrad and then 2 years later, this industry. I just didn't, right? Mm-hmm. It was, instead of selling beef, I'm going to sell mutual funds. It was literally that simple. Like, the decision was not about modern portfolio theory or the benefits of diversification or how to allocate your assets at all. It was, okay, you're selling a cow. Literally, you're selling a cow one day to selling a mutual fund the next day. And look, we do it. You can do it. It was nothing more than that. I knew nothing. I don't say that with pride. I'm proud of how I changed, but how I joined the industry is ridiculous. I knew the industry I knew there was a need for this part of the industry. I'd read The Wealthy Barber and David Shilton, I knew about that revolution. Yeah. But in terms of the implementation side, clueless, embarrassingly clueless. And you did a simple exam and went to market. It's crazy, completely. We were selling mutual funds. We were getting free laptops, and I remember getting a leather jacket once for selling a bunch of mutual funds. I mean, this is nuts. Nuts.
Yeah. And it's changed a little bit, I think.
It's changed a lot. The industry's changed a lot. This goes back to the Gloria and Stromberg report of the 90s, and a lot of things have changed to the industry's credit. Back-end load funds are gone now.
Yeah.
So things are much, much better. And the product that's available, like, you can get a beautifully built portfolio for 10, 20, 30 basis points.
Yeah.
Right?
Yeah.
That's probably less than half the operating cost 30 years ago.
Yeah.
I remember being like, we would go to dinners or sessions with the ETF manufacturers and have them explain to us how an ETF actually works. Like the whole creation redemption mechanism.
Yeah.
It's like this mind-blowing thing, right?
I like how you did magic hands there. Like,
and you guys do this for like 5 basis points.
Yeah.
It's like, what are you talking about, 5? The advances in technology in this space are simply mind-boggling. You can get a globally diversified portfolio today for, what is the Vanguard? 18, 20, 22 basis points?
Yeah, 20 at the low end, I think, for my shares, and then Vanguard's like 22 or
dimensional value, tilted, rebalance, beautiful implementation portfolio for 30 or 32. Like, this is just incredible technology.
Yeah.
Right? So I don't have any regrets. Maybe you should have known some stuff earlier, but super happy with what we did and the luck and whatnot along the way. And where we are today is just, it's an amazing spot.
Yeah, that's great. So there's, I was looking this up the other day. There's over 100,000 licensed advisors in Canada, if you include insurance licenses. And we have some of the highest per capita advisor to consumer ratios in all of the developed world, which is really interesting. And as you know, there's a lot of listeners out there that are advisors, but there's a lot of consumers out there too. And what do you think consumers can do to ensure that they're getting advice that is aligned with a lot of the things that you've discussed here today? Because the consumer generally, unfortunately, I mean, if there's a big cohort of advisors out there that don't know about this, like you said, these revolutions that are happening, then I would expect even fewer consumers to understand that. So as a consumer, what do you think they can do to ensure that they're getting advice that's optimal?
I don't know. That is so hard.
Yeah.
And I think it's particularly hard in Canada with the environment, with the dominance of the banks in the country.
Yeah.
I'm not saying banks are necessarily bad. There's a lot of great people at the banks. I'm not saying that at all. But if you're going to go outside of that channel, where are you going to go? Who are you going to trust? Like Ghostbusters, right? Like, who are you going to call? It's like, and if you're not trained to know the difference, how do you know it? It's really, really hard.
Yeah,
no, I'm very sympathetic to that. What do you think is the answer?
I don't. I gave a presentation over the weekend to at the Physician Financial Independence Conference. So there's a huge growing cohort of physicians in Canada that are trying to take personal finance into their own hands. And actually, Ben and Dr. Mark Soth, the Looney Doctor, they did a live Money Scope podcast there, and I was also asked to present on common mistakes that physicians make. But anyways, the first one was everybody wants your business, not everyone deserves it. And I think the level of due diligence that people should be, and this doesn't just apply to advisors, this applies to any professional that you're going to be hiring for services, but the level of due diligence that you need to do to make sure that you're getting something worth paying for, I think is very, very high. These days, luckily, I think it's a little bit easier to vet people just because of the internet. Like, I mean, think about this podcast, the writing I do on Twitter and the blog posting, everything. Like, part of that social proof is that we're out there trying to say, like, hey, like people contact me all the time and they're like, I already know you because I've been following you and that type of thing, right? So I think consumers should probably gravitate towards people that have made their thoughts public, at least so you can get an idea not only of their expertise and skill level, but about their style and that type of thing. Interview more than one person. I always say, like, even when I'm talking to people who might be interested in PWL services, I'm like, go interview some other people. Like, go talk to a couple firms, right? Like, make sure that what we are offering to you is the thing that you need. And then I think referrals go a long way if you've got, close, trusted family or friends that have been working with a professional for some time and they're pleased with it. I think that goes a long way. But for consumers, it's really tough. There's so much noise out there.
Mm-hmm. I agree.
Yeah. Okay, a couple more. What do you think the advisor community should be doing to improve the industry?
Well, I mean, we're doing our small part by putting out content like this. We do a lot of, part of our value system is to put information out to the world with the belief that it's going to come back in some way and help us, right? The unintended consequences. Mm-hmm. Like the tools that Braden has built and the white papers that we put out and this podcast and Ben's YouTube and all the work that you and many others here do. So I think we're doing our small part of it, is putting information out there, trying to make the industry better. Kudos to Ben for doing joint projects with other advisors and other firms. I think that's pretty cool.
Yeah.
Right. There's more than enough people for us all to help. All of us. Everyone needs help.
Yeah.
So many people are underserved. So it's not about hoarding business at all. Mm-hmm. That's what comes to mind off the top of my head.
Yeah.
To try to help. What do you think?
No, I think that's really, really important. To your point, it's sort of like this abundance mentality, right? I mean, a lot of people keep things really close to the chest and they're hyper competitive, but like at the end of the day, there's so many people that need help. There's so many great advisors out there that cross firm collaboration you talked about with Ben and that kind of stuff. Like, I've got a group of friends and they all work for different firms and I pick their brains about stuff all the time and we talk about planning scenarios and this kind of stuff, right? And there's just so many good people out there that do want to help, and I just think if we continue to do the things that we're doing, like the podcast and focusing on financial education and literacy and that type of thing, Karma works from that perspective. Shout out to FPAC, the Financial Planning Association of Canada. They're doing a lot in that realm, like just from the regulatory standpoint even. So there's these kind of grassroots movements that are popping up all over the place, and just get the message out, I think. Okay, last question. Do you think the future of advice looks different from the past?
Oh, that's a great question. I'm kind of torn on this because so many people don't have just basic advice. Like, something as basic as a good person to talk to get basic advice about how portfolios work, how financial planning works. So many people just need that. That doesn't require AI. That doesn't require a lot of technology. Just the basic meat and potatoes, solid, trustworthy, straightforward, respectable advice and implementation. So that's on one hand. So many people still don't have that. Yep. But on the other hand, when you think about what is possible in this new world of technology, it is truly amazing. Some sort of digitally enhanced environment where AI is helping pick up on social cues and conversations to help give better advice, where the platform can help the advisor understand you better and comb through the different meetings you've had with your advisor to pick up on trends of mood and empathy and all these different things to help you realize things that you might not even know about you and your money life. There's so many fascinating things going on in that space. Like, I can't wait to see how that might play out. And who knows how it's going to play out. It might be a big flop. It might be completely game-changing. So I'm kind of torn on that.
Yeah, it's interesting to see, hey. But I think you're right, though. And like any big technological revolution, there's going to be people that embrace it and people that don't. And it can enhance people who use it correctly and enhance their practices and the way they do things. It can change the way they do things. And if anything else, it might eliminate some of the kind of lower hanging fruit. But at the same time, those who embrace it, I think will do well.
Call me nuts, but the past decade, there's been this infatuation with having portals and beautiful graphics of your portfolio and returns and all this stuff. It's like, yeah, that's all nice and beautiful and cool, Robinhood and trading platforms and all this. But it's like, really?
Yeah.
Really? How many people actually got the returns of what the total market offered over the past 30 years?
Oh, so few. So
And
like,
would a digital interface have helped you? Like,
no,
it probably
well,
would have hurt you.
I have a small account at another firm because I put some money away for my son,
Yep.
and they've got an app, and it's just really easy to see, and it's really intuitive, and he's 6, right? And so it's just easy for me to just like, let's throw some money in there. I'm trying to teach him about volatility in the markets and that kind of thing. But because I have this app on my phone, I find myself, I don't check my own personal portfolio, like literally never.
No, I know you don't.
Never. But this little app with like a meaningless amount of money in it that's on my phone, I'm like, oh, like it's so enticing, and like you get a notification or whatever, and that addiction to being able to seek information at your fingertips. To your point, I think it really throws a wrench in the behavioral side of portfolio management, and people just make so many bad decisions, and now they're just making it easier to make bad decisions. And whether you know it or not, every time you look at your portfolio, you're making a decision: buy, sell, or hold. Whether you recognize that or not, you're making a decision. And the more times you're forced to make a decision around something, the higher the probability that you're going to introduce an error into your decision making, right? And so it just becomes very obvious to me that the easier we make it for people to tinker, the worse things are going to go for them overall.
So if you're a pro and you don't need some fancy interface, why would end users need it?
Because I think a lot of them think that's a benefit in some way, I guess, right? Like the ease of access to which you can buy call options.
Need is different than wanting. They might want
totally,
it.
Yes. But I think it's, for a lot of people, they don't know the difference between the need and the want, right? And they think that information is always useful, and that's not necessarily the case, right? I just don't think if you're a long-term investor, it's just so irrelevant. You know what I mean? Like, it's just, you don't need
Completely irrelevant. And if you believe markets work.
Yeah. Now, on the planning side, I think it's maybe more interesting. Like if there's tools that allow you to kind of engage with your own finances in other ways, like budgeting and tracking apps and that kind of thing, maybe on the portfolio side, I'm less interested.
Yeah, that I agree with, because people change, situations change, and to have an environment where you can kind of go in and maybe put in some of your metrics and have the advisor aware that you're in there playing with it, so you can have some sort of perhaps a digital platform for communication back and forth on stuff. So you kind of put in this, I was thinking about, sending my daughter to university, whatever, a year later, what's the impact on the plan? Or maybe I want to retire a couple years earlier, because that comes up a lot. Yeah. And it may not be a rushed answer to get back, but you go into the environment and play with it, and you can go back and say, I noticed you're doing this. So I think that would be really, really fascinating.
Yeah, that's true. Little kind of sandbox environments where you can test things yourself. And a lot of what we do is just interpretation, right? Like the software itself, as powerful as it may be, is really not the thing that we deliver to clients. It's interpreting models and interpreting projections and that type of thing. So on the one hand, you don't want people to have so much power that they can really mess with things, because they might not know what they've done, or they might not be able to explain the impact of certain changes they've made if they're doing their own plans and that kind of stuff. So you want to put, I think, some guardrails around that stuff if that's what you're doing.
I gave a presentation this morning to a firm in the U.S. that asked to talk about a bit about our firm, and I was talking about kind of Ben and Braden's realization when they're building out some of these tools, that often planning industry will give feedback, kind of rule of thumb type feedback, but some of these inputs are so complicated, like different tax inputs, different planning inputs. But then when you overlay, well, what's your objective? Do you want maximum income at retirement? Do you want to retire earlier? Do you want maximum estate? Like, depending on what your variables are, this becomes an impossible matrix for a human mind to be able to do on their own. You have to build out an algorithm to help solve this. And until you start to see that, you're unable to give the advice. Yeah. I mean, that was a huge realization that those guys had when building out these models.
So it's super complex, just in and of itself, but then you add humans to the mix, and it becomes, there's no rule of thumb. And I hate rules of thumb as a rule itself. But
is there anything else cool going on in your world?
What's going on in my world? Is there anything cool going on? There's got to be something, right? Like, I don't know. Halloween was lots of fun. Took the kids out trick-or-treating. That was great. My daughter's 19 months. She's starting to talk now.
Oh, wow.
Just in the past, like, she's always had like a good number of words for her age. She's like, hitting the appropriate milestones. But in the past couple of days, she's just started repeating everything we say in her little baby speech, and it's just the best. Oh, I know, but it's just amazing. Like, to just hear her say things like whoopsies after she drops something, and it's just yeah. So she's at this kind of like, I don't know. It's exploding. Her vocabulary is exploding just over the past couple of days. It's just so much fun. You? What's going on? We just got back from a big trip, but what else is planned?
Big trip, yeah, and we had our amazing Australian trip. So something I learned, and it's the recent travel that causes, but I never paid attention to Aeroplan points and status. I never even thought about it, right? And I noticed I got these. We were in Norway last week, and I noticed I got these upgrade credits or something. I had no idea what it. I mean, I know what an upgrade is. I'm not, but I didn't know how it worked, right? So I started playing around with it. So for like a couple of upgrade points, and I had like 40 of them or something, I was able to get like an upgrade on, like I'm going out to Vancouver, as you know, in a few weeks. Able to get like an upgrade on the flight to Vancouver for like 2 points and no money. Now, that's pretty cool.
Wow.
Yeah. So I just started playing around with this app, and I'm starting to understand how it's going to slow down now because my travel schedule is going to be dramatically less going forward.
Yeah.
But a trip to Australia and then Norway will, add up points a little bit quicker.
Yeah. There's like entire blogs dedicated to like travel hacking, right? Jordan told me about one, Prince of Travel, I think, and it's like travel hacking to the extreme. And there's people that are like devout travel hackers and points hackers and that kind of stuff, and making sure they're maximizing stuff and opening multiple credit cards and buying some things on one, some things on the other to get all these points. And
really,
I'm like you. I've completely ignored it my entire life, and I don't think I have even as much as like an Aeroplan points number or whatever. I'm just like, I just don't want to keep track of all this stuff. You know what I mean? Like, yeah.
But you see how it brings you in because you want to keep your status, right?
Yeah.
We also learn because we get whatever level of status, I don't even know, but you end up being in a lower number boarding group, which means less risk of not having space for your carry-on luggage, which of course is the eternal issue when you fly in Canada.
Yeah.
There's enough space for you, so you get that carry-on luggage stress going on if you're in group 5.
Yeah, that's why I only ever bring a backpack because I can tuck it under the seat in front of me. That's my number one rule.
It's the Ben Felix way of traveling, always with a backpack. Anyways,
but his backpack,
I realize I'm in a privileged position for reason travel for that. So, but it's a world I had no idea about. So
yeah, me neither.
But other than that, man, we're a month away. Well, just under a month away from Christmas. It's crazy. This year has just flown by.
Yeah, no, it has. I was thinking about that the other day. I can't remember why, but yeah, it's almost a new year. I'm off to Mexico again for Christmas this year. Looking forward to that.
No kidding. Love it. It's awesome. Yeah. All right. This has been fun, Mark. We should do 2 of us more often.
Yeah, it's just casual. I mean, who needs Ben Felix, right?
Like Ben, I mean, we can get a new podcast to start. We'll just have the Rambling Guys podcast, or maybe he'll tell us to get our own after this.
Yeah, that's true. He can take the rational reminder.
Or maybe he'll kick us off this after this. We'll never be back.
Yeah, that's true. Yeah.
Be him and Dan. This might be our swan song.
This might be the last one. Yeah.
All right.
Awesome. It was good.
Great to see you as always, everybody. Thanks for listening. Have a great day.